Welcome back to the deep dive. We are your guides, really digging into the financial world, trying to pull out those technical details and the context you need to, stay ahead. And today we're looking at something pretty seismic, I think, a real structural shift in how traditional finance is starting to interact with crypto. We are talking about Grayscale, of course, a huge name, and their launch of what could be a game-changing product, the Grayscale Digital Large Cap Fund, GDLC.
Yeah, this really feels like a pivot point. I mean, for years, the whole Wall Street conversation was very narrow, right? It was Bitcoin, maybe Ethereum more recently. GDLC, though, this is like the definitive signal that institutions are accepting crypto as a legitimate multi-asset class. It sort of forces a change in how all that managed capital, trillions of dollars, looks at the Web3 space.
Right. So our mission today is pretty focused. Grayscale's launched the first index-based spot crypto ETF. We want to go deeper than just the headlines, really pull out the core implications. What's this mean for diversification? How does it immediately, turn up the heat on competitors, the big ones like BlackRock and Fidelity? And maybe most importantly, what are the ripple effects going to be for altcoins? Where does the money flow?
Exactly. We've gone through a pretty big stack of sources, fund structure analyses, regulatory stuff, looking back at historical parallels with other ETFs. So whether you're, actively managing a portfolio, just trying to figure out where this next wave of institutional money is heading, or maybe you just want to be the sharpest person in the room on Web3 finance, this deep dive should give you that comprehensive view without hopefully overloading you.
Yeah, we want you to really get the different angles, those sort of technical aha moments behind this story. Now, before we really unpack why everyone's talking about GDLC as the potential SPY ETF of crypto, that foundational index product, we just wanted to say a quick thanks to you, the listener. We're really committed to bringing you these pretty intense, high-quality analyses. And subscribing, commenting, engaging with the video, it honestly really helps the channel. It boosts us in the algorithm, lets us keep making this kind of in-depth crypto content. Your engagement, well, it makes all this possible.
It absolutely does. Okay, let's get into it.
Okay, let's unpack this then. The foundational event, GDLC, is officially launched, but maybe we should start with Grayscale's history here, because for years they were all about GBTC, the Bitcoin Trust, which was, well, it was different, right? It was a closed-end fund. How does GDLC, being an index-based spot ETF, mark such a big departure?
Oh, that transition is crucial. GBTC was definitely groundbreaking for its time, but yeah, it operated as a trust. That meant it often had liquidity issues. It could trade way above or, like recently, way below the actual value of the Bitcoin it held, those premiums and discounts. Plus, the fees were pretty high.
Right, the infamous GBTC discount.
Exactly. GDLC is totally different. It's a regulated spot ETF, meaning it's open-ended. They can constantly create and redeem shares, and that mechanism basically anchors the trading price right to the value of the crypto inside.
Yeah.
It's the standard, efficient structure that TradFi knows and frankly demands.
Okay, so that immediately fixes that premium discount headache that plagued GBTC. But the really key difference here is the index part, the composition. What's actually in GDLC?
Yeah, that's the core differentiator. It tracks a basket of leading cryptocurrencies, not just one. It's passive, designed to mirror an index, probably market cap weighted. So you've got Bitcoin and Ethereum in there for sure, but also proportional amounts of other big established altcoins that meet certain criteria. Think liquidity, custody solutions, maybe some regulatory checks.
So Grayscale isn't betting on Bitcoin versus Solana, for example. They're offering exposure to the crypto sector as a whole, using that tried and tested indexing approach from traditional markets.
Precisely. And that's the big shift in mindset. What's fascinating is the regulatory angle. Getting a Bitcoin ETF approved meant regulators had to view Bitcoin basically as a commodity, right? Subject to specific surveillance agreements. But approving an index product holding multiple assets, say 5 or 8 or 10 different coins, that suggest regulators are starting to treat crypto more like a standardized asset class. Not just this collection of individual speculative tokens that each need their own, often messy approval fight.
It sort of acknowledges that the ecosystem is bigger than just BTC and ETH and gives institutions a regulated way to get that broader exposure.
Yeah. And you can't really overstate the significance there. The index fund is the go-to mechanism on Wall Street. Yeah. This bridges that gap between traditional investment tools and the dynamic Web3 world. It becomes the default diversified starting point for those big institutions that have really strict risk rules.
Okay, so this shift is huge. We've kind of broken down the impact into 3 main pillars. Let's start with the first one. Accessibility and custody. This is where it gets really interesting, I think, because GDLC doesn't just lower the barrier, it kind of nukes the biggest operational nightmare for TradFi investors, right?
Absolutely. The custody challenge is, well, it's paramount. We talk a lot about self-sovereignty in crypto, which is great. But if you're managing a multi-billion-dollar pension fund or, a company's treasury, the thought of handling private keys, setting up super secure cold storage, doing constant expensive security audits,
Yeah.
it's an operational nightmare.
Yeah.
The liability, the complexity is just not acceptable for their risk model.
It's a completely different skill set, takes them way outside their main job of just allocating assets. GDLC just removes that friction entirely.
That's the beauty of the ETF structure. It shifts the entire burden, custody, regulatory compliance onto the issuer, onto Grayscale.
Yeah.
So investors, they get diversified crypto exposure instantly through a regular stock exchange vehicle. It's exactly like buying shares of SPY or a gold ETF. They don't touch the keys. They don't worry about securing the actual blockchain assets.
So the result is, yeah, much lower barriers for everyone, from maybe a retail person just starting out all the way up to the biggest institutional funds. It's like the ultimate regulated on-ramp for diversified crypto.
And that ease of access flows right into the second pillar, mainstream legitimacy.
Right. So connecting this to the bigger picture, why is approving an index product a stronger signal than just approving, say, a Bitcoin fund? What makes the index classification so powerful for legitimacy?
Well, because it signals standardization and systemic relevance. When regulators approve an index, they're implicitly saying that the underlying market, that collection of assets, is mature enough, robust enough, definable enough to be tracked and measured, used as a benchmark. It moves crypto away from being just a fringe high-risk bet toward being a recognized mainstream benchmarkable asset class. It suggests regulators see the top layer of crypto assets as mature enough to be packaged up alongside traditional indices, like the Russell 2000 or the Nasdaq Q.
It's like the difference between regulators saying, okay, you can trade Bitcoin safely versus saying, okay, crypto is an asset class we now need to accommodate within our existing frameworks. But doesn't that create a weird tension? Are regulators now sort of forced to approve assets bundled in the index, maybe assets they don't fully understand yet just because they're riding alongside Bitcoin and Ethereum?
That's a really interesting point, and it gets at that intellectual friction. The approval of GDLC hinges on the idea that the big altcoins in that basket have reached a certain level of liquidity and market integrity, similar to the bigger players. The due diligence for an index is definitely more complicated. So the approval suggests they're comfortable or comfortable enough with the risk profile of this basket approach. It actually sets a pretty high bar for which altcoins can even get included, kind of validating their structure and market setup.
Gotcha. And that leads us to the third pillar, the competitive landscape. The second Grayscale launches this diversified index ETF, it basically forces everyone else's hand, right?
Oh, absolutely. It's classic competitive pressure.
Yeah.
When Grayscale offers this broad, diversified exposure, the other giants, BlackRock, Fidelity, ARK Invest, usual players, they can't really afford to just sit there offering only Bitcoin funds or waiting around for an Ether ETF approval.
Right.
That institutional money looking for diversification will naturally gravitate towards GDLC. So to capture those funds, the rivals are going to be pushed, probably pretty quickly, to launch their own similar diversified or index-based products. We're likely going to see a product war kickoff, competing on fees, maybe slightly different index methods, arguing about which altcoins are in their basket.
So it's not just Grayscale winning market share, it's forcing product diversity across the whole crypto ETF space. And that competition, fueled by FOMO on those institutional flows, ultimately helps the market by speeding up innovation in these Web3 financial products.
Yeah, definitely benefits the end investor ultimately. Okay, so let's talk portfolio construction. This is where GDLC really starts to look attractive for those more risk-averse funds. If a fund just buys, say, Bitcoin, they're exposed to concentration risk, right? Like a project-specific bug, a regulatory hit just on Bitcoin, some technical issue unique to that one chain.
And that concentration risk is often a non-starter for big pools of capital, like pensions. It violates their fiduciary duty requirements.
Exactly. Fiduciary duty means managing risk responsibly. An index ETF inherently smooths that out by spreading the capital across multiple assets that are hopefully not perfectly correlated. GDLC offers a way to dampen the volatility compared to just picking individual tokens. If Solana has a rough week or Cardano faces some regulatory hurdle, the Bitcoin and Ethereum in the basket help cushion the overall impact.
It's diversification 101, basically, but now applied cleanly to a basket of digital assets.
And we should touch on the mechanics of the index itself, specifically rebalancing. This is a really crucial detail for any index fund. GDLC has to follow a set methodology, probably rebalancing its holdings, say, quarterly or semi-annually based on how market caps have shifted, and that rebalancing act forces buying and selling.
Ah, I see where you're going. So if an altcoin that's in the index suddenly takes off and outperforms the others, its weight in GDLC naturally grows. To stick to the index rules, Grayscale then has to buy more of that winner during the rebalance and maybe sell a bit of the underperformers to match the target weights.
That's exactly right. And this mechanism essentially pushes institutional capital deeper into the ecosystem, based purely on market performance metrics, not just funneling everything into BTC and ETH forever. Which brings us right to the big altcoin question.
So what does this all really mean for the rest of the market beyond Bitcoin and Ether? The key prediction seems to be that these index products could finally create a sustainable, almost automatic flow of institutional money into altcoins. Is this the structural shift altcoins have been hoping for?
It definitely raises that critical question. How will GDLC, and potentially others like it, affect altcoin dominance? Bitcoin currently holds a huge chunk of the total crypto market cap. If billions start flowing into a diversified product like GDLC, which is required by its rules to allocate some funds to, say, Solana or Polygon, or maybe some established DeFi tokens if they meet the criteria, well, that buying pressure has to start tilting the overall market cap balance away from Bitcoin, at least somewhat. We should probably expect the altcoin dominance chart to show a steady, maybe slow but persistent increase because of these institutional mandates.
That would certainly support the idea that crypto is maturing, becoming a multi-asset class where capital isn't just hyper-concentrated at the very top. But let me push back a bit here, add some friction. Doesn't the whole diversification benefit kind of evaporate if the entire crypto market, including the altcoins and GDLC, is still super highly correlated to Bitcoin? Historically, when Bitcoin tanks, pretty much everything else follows. Are institutions really getting genuine diversification, or are they just buying slightly diluted Bitcoin exposure with higher fees?
That is a vital counterpoint, absolutely. And it's exactly why sophisticated investors will be watching the correlation matrix of the assets inside GDLC like a hawk.
Yeah.
If those correlations stay close to one, meaning everything moves in perfect lockstep, then yeah, the diversification benefit is mostly gone. The index just becomes a more expensive, watered-down Bitcoin fund. But the hope, and really the underlying thesis behind approving GDLC, is that as the market matures, different sectors within crypto, like DeFi or gaming or infrastructure plays, will start to show lower correlations to each other. Their prices will be driven more by their specific use cases and fundamentals, not just Bitcoin's overall macro tide. GDLC is essentially a bet that that decoupling will happen, or is already starting to happen.
Okay, that makes sense. Which leads us to the final big implication here. This sets a precedent for future ETFs, right?
Absolutely. GDLC's approval is a massive regulatory proof of concept for thematic crypto products. If regulators are okay with a general diversified index, well, that clears a significant hurdle for more focused, sector-based ETFs down the road. We could realistically start talking about seeing, maybe, a dedicated DeFi basket ETF just tracking tokens core to lending protocols and DTS, or maybe a gaming basket ETF focused only on Web3 gaming projects, or even an AI basket ETF tracking decentralized compute tokens.
That really modularizes the crypto market for investors in a completely new way. A fund manager could decide, okay, we're bullish on decentralized compute long term, and just buy the AI basket ETF without needing to individually research and vet, 15 different projects and their teams and security.
Yeah, it lets them invest in the theme or the sector idea rather than picking individual winners. And interestingly, this could even echo back into the native crypto space itself. It might speed up the creation of tokenized indices within DeFi protocols. You could imagine synthetic tokens on a DX that represent the GDLC basket, trading 2-1-7, maybe responding even faster to market shifts than the ETF itself. It just further blurs those lines between TradFi structures and native crypto innovation.
Okay, to really grasp the potential scale here, it helps to look back at financial history, right? This isn't the first time a simple, regulated product has basically unlocked an entire asset class for the mainstream. Let's start with that gold ETF parallel from, 2004?
Yeah, that's why the cleanest analogy, before the first big gold ETF, specifically the SPDR gold shares, GLD getting exposure to gold was, well, it was clunky.
Yeah.
You either had to buy physical gold bars or coins and deal with storage, security, insurance costs,
Right.
or you had to navigate the futures market, which was complex, often involved leverage, and scared off a lot of conservative investors.
It was mostly for specialists or maybe dedicated gold bugs.
Exactly. Then GLD launched. Overnight, it democratized gold investing. Suddenly, you had a simple regulated security you could buy in any regular brokerage account. It legitimized gold, moving it from the fringe, or just an emergency hedge, into a standard portfolio allocation for big institutions. It drove massive new liquidity into gold and is widely seen as a key factor behind gold's big price run over the next decade or so.
And the argument is that crypto's following a similar path. GDLC provides that same kind of accessibility and regulatory wrapper that GLD did for gold, but this time for a whole basket of digital assets.
Now, let's talk about the big comparison being made, the SPY analogy. GDLC is being talked about as the potential SPY of crypto. We should probably explain why the SPDR S&P 500 ETF, SPY, is so significant. It's way more than just a big fund.
Yeah, SPY is like a foundational plumbing for the stock market. Launched way back in the early 90s, it gave investors super simple, cheap, effective exposure to the whole S&P 500 index. It really changed investing forever because you could instantly diversify across 500 major U.S. companies with just one trade, and it was incredibly liquid.
SPY basically created the template for passive investing as we know it. Before SPY, if you wanted diversification, you were looking at high-fee mutual funds or trying to buy dozens, even hundreds of individual stocks.
Yeah.
SPY offered a low-cost, transparent way to just buy the market. And importantly, its massive liquidity made it the go-to underlying asset for the derivatives, market options, future structured products. It became this essential tool for hedging, for leverage, for risk management across the entire financial system.
So the idea is a GDLC isn't just trying to be another crypto fund. It's aiming to be that default infrastructure, the base layer for crypto exposure that institutional traders will use to manage risk, hedge their bets, build portfolio models. It's kind of the, I want crypto exposure, but I don't want the headache of picking individual winners choice.
Exactly. That simplicity, combined with the regulated structure, is potentially the key to unlocking truly massive institutional flows.
And we don't have to look far back for proof that this kind of liquidity can show up fast. Just look at what happened with BlackRock's Bitcoin ETF earlier this year, right?
Oh yeah, that's the perfect recent case study. The moment those spot Bitcoin ETFs got approved, billions just flooded in almost instantly. Retail money, institutional money. It blew past even the most optimistic forecasts. It clearly showed just how much pent-up demand there was in TradFi for easy, regulated ways to get crypto exposure. So if a single asset product like a Bitcoin ETF can pull in that kind of capital, you can imagine the appeal of a product like GDLC that promises exposure to the sector's growth while minimizing that single asset risk.
Right. And finally, maybe we should touch on those earlier index pioneers like Bitwise. They sort of laid the groundwork for GDLC getting approved, didn't they?
Bitwise was absolutely crucial, yeah. They started not with ETFs, but with private crypto index funds targeted at accredited investors. But they were the ones really figuring out the methodologies, the precise rules for how you select, weight, rebalance, and audit a basket of these really volatile digital assets. They did that heavy lifting long before the SEC was even close to approving a spot product. Their focus on rigorous methodology and compliance basically demonstrated to regulators that, yes, a responsible index-based approach to handling multiple cryptocurrencies was possible. They provided that essential proof of concept, validating the kind of infrastructure that Grayscale is now building on with GDLC.
Okay, so this is where we shift gears a bit and try to give you, the listener, some tools. We've talked about the why of GDLC. Now let's focus on the how. Like, what specific things should you actually watch to gauge its success and its impact on the market?
Right, the first, most obvious one is just follow the money. Track the inflows into GDLC. How do they compare to the inflows going into the established single asset ETFs, especially the Bitcoin ones? If GDLC starts taking a significant bite out of the market share held by the BTC ETFs, that's a pretty clear signal that investor preference is structurally shifting towards diversification.
Makes sense. Second, you got to know what's actually in the ETF, right? So track the official allocation breakdown. What's the weighting? Which specific cryptos make up the biggest chunks after Bitcoin and Ether? Is Solana getting a big piece? Are there any DeFi tokens in there? Seeing which specific altcoins are benefiting tells you where institutional conviction, filtered through that index methodology, is actually landing.
Third, and this is maybe the key metric for the whole ecosystem, keep an eye on the altcoin dominance chart. We've mentioned this, it tracks the total market cap of all altcoins compared to the total crypto market cap. What we're looking for are signs of a real, sustained shift away from Bitcoin's dominance. If institutional money flowing into GDLC forces that proportional buying of altcoins during rebalancing, This chart should show a structural change in market share over time.
Yeah, that would really confirm the idea that GDLC is actually spreading institutional capital across Web3, not just concentrating it further.
Fourth, for the more sophisticated investors worried about risk, you absolutely have to watch the correlation matrix of the assets inside GDLC. Do the assets maintain reasonably low or moderate correlations? If they do, the fund is delivering genuine diversification. But if those correlations spike way up, say above 0.8, especially during market downturns, well, that supports the skeptical view that it's just diluted Bitcoin exposure and the diversification benefit is kind of an illusion.
That's a crucial one. And finally, maybe compare the launch trajectories. Don't just look at GDLC versus other crypto ETFs. Look back at the gold ETF launch in 2004, look at the Bitcoin ETF launch earlier this year, and now watch GDLC. Is it showing that same kind of exponential growth curve in adoption and assets under management? Comparing its growth rate to those historical parallels gives you a sense of how ready the mainstream market perceives this multi-asset crypto class to be.
Okay, so let's wrap up this section by posing maybe the two toughest questions the market has to grapple with now. First one is about performance. Could an index ETF like GDLC actually outperform a single asset product like a Bitcoin-only ETF over the long haul?
Ah, the classic passive indexing versus active or concentrated picking debate. But now for crypto. I mean, if the altcoins in the index go through several huge growth cycles fueled by all this new institutional money, then yeah, maybe the index could deliver better risk-adjusted returns because of that diversification and the winners pulling it up. But if Bitcoin just continues to dominate and massively outperform everything else, then the index might actually lag behind because it's forced to hold those smaller, underperforming assets.
It's a real question. And the second big question is about the regulatory path. Okay, regulators approved a diversified index, which arguably is a heavier regulatory lift than just approving Bitcoin. Does this mean they'll be more open to even broader or maybe even more niche crypto ETFs in the near future? GDLC sets a really significant precedent for what's now considered acceptable when bundling digital assets into these structured products.
That precedent feels like maybe the most critical unlock from this whole launch.
I think so too. Hashtag tag outro.
So just to kind of synthesize and wrap up our deep dive here, the launch of Grayscale's GDLC isn't just another product announcement. It feels like a really fundamental structural shift happening at that intersection of Wall Street and Web3. It brings much-needed diversification to a market known for volatility. It grants a huge dose of institutional legitimacy to crypto as a multi-asset class. And it definitely ramps up the competitive pressure, forcing all the TradFi giants to broaden their crypto game, probably pretty quickly.
Yeah, it tackles that big custody hurdle, it minimizes the single asset risk through indexing, and critically, it carves out this regulated, efficient path for potentially billions in mandated capital to flow deeper into the Web3 world, beyond just Bitcoin and Ethereum. It's like the financial plumbing is finally starting to catch up with the innovation.
Right. And that infrastructure shift really begs a final, maybe provocative question for you to think about, building on that regulatory precedent we just discussed. If regulators signed off on this kind of diversified index product, what's the logical next step? Maybe even the inevitable next step for the crypto market?
We talked about thematic funds, but how fast could that really happen now?
Exactly. Could GDLC be the moment that really opens the floodgates for approval of deep sector ETFs? Do you think we're going to see like a dedicated DeFi ETF soon, just tracking lending protocols in DX tokens? Or maybe a gaming ETF focused purely on blockchain gaming? Or, and maybe this is the wild card, riding that wave of regulatory comfort, could we even see something like a meme coin ETF down the line? That's definitely something to mull over as you watch how GDLC performs in the coming weeks and months.
Yeah, we'd love to hear your thoughts too. Which niche crypto ETF do you think gets approved next, and why?
Absolutely. Well, thanks for joining us for this pretty crucial deep dive into how crypto finance is evolving. Until next time, keep learning and stay sharp.